What's up, everyone? Dylan here. I wanted to hop on and do a brief overview of what's been occurring in the market. In this video, I'm going to be covering both fundamentals and technicals to not only give you an idea of how to read sentiment, but also give you guys an edge on how to predict future price movements. So with that said, we will hop right into it. So over the last 2 weeks, the market has been able to stay resilient despite some hawkish news that has been coming out. So over the last 2 weeks, we've seen a very hot jobs number, right? The jobs report came in nearly double what the street was anticipating, okay? We also had a hawkish CPI and PPI print, right? Both the CPI and the PPI came out above expectations, right? Hawkish CPI, hawkish PPI, and the hawkish jobs number are all inflationary, okay? That is no good for the market, right? That is perceived as bearish. On top of that, we also had an ugly Michigan sentiment release this past Friday, which showed not only a sharp drop in confidence, but also a spike in inflation expectations. If those weren't enough, we also got geopolitical headwinds out of, the Israeli attacks. So these are, multiple different things that are acting as headwinds in the market, yet the S&P has managed to absorb a lot of that negative sentiment and sustain value. Okay, so that's very, very important. Okay, so I'm going to be going over some technical ideas to look out for going forward, and also some fundamentals that kind of revolve around some of the technicals. So going forward, we want to look at this S&P trend line, okay? If the market remains resilient, right, despite a lot of the things that have been occurring, and price manages to move higher, this is a trend line that acted as previous support, and now we can speculate that it's going to turn into resistance on any retests. Okay, so this marked the October lows as well as a few wicks back in early to mid-March. Okay, once it was broken below, we've had not one but two retests. Okay, on top of that, this trend line also kind of lines up with the 50 simple moving average on the S&P 500 futures. Okay, so going forward, if the market continues remaining resilient despite some of the macro aspects that it's being met with, look out for this general area, right? Between say 4441 and 4455. So that 15-point area will be very important going forward. Okay, so one of the biggest fundamental or macro things to look at is yields. Okay, so yields have been a very, very important fundamental aspect that has been putting a lot of pressure on the market, right? A large portion of the reason as to why the S&P was in a downtrend over that period of time was because of surging yields, okay? So in order to have an idea of what yields are doing, you can either look at TNX, which is the ticker, right? TNX. Or you could, if you're using TradingView, you could also type in US10Y, which will represent the same exact thing, just in a different instrument, okay? So for this case, we're going to be using TNX, okay? So the higher yields go, right? This is the 10-year Treasury note yield. The higher this moves, the more pressure will be put on the S&P, okay? The higher this thing moves implies that inflation is staying, higher for longer, okay? So the continued yield spike is implying that inflation is bouncing back. Okay, so talking about the geopolitical headwinds that I just noted, that is causing the price of oil to spike higher, right? By looking at the CPI reports, we have seen that energy has remained fairly sticky. Okay, so the higher oil goes, the higher this TNX will likely go because inflation is rising higher. Okay, so this also implies that the Fed may have more rate hikes as well. Okay, and this also higher yields implies that there could be banking stresses as well. So remember, in the earlier months of the year, we had the banking stress, right? Part of the reason as to why a few banks blew up were because of higher yields. Okay, so like I said, the higher TNX goes has a lot of implications on other market variables. Okay, so definitely keep an eye on TNX. In terms of technicals, you want to look at that 5 psychological number on TNX. Okay, this implies that the 10-year yield will be at 5% if it crosses that 5. Right, these are just percentage points on the y-axis. Okay, so essentially, if TNX rises to 5%, which is a psychological number, there's going to be much more pressure on the S&P 500, the Nasdaq, and all the other indices, which is going to drag down the market. In plain English, that is very bearish, the market. So if we go to a monthly chart, current prices on TNX we have not seen since 2007, which, if you think about it, was the year before the financial crash back in 2008. Okay, so obviously having higher yields puts the market at risk to a few things blowing up. In plain English, you have higher mortgage rates, you have higher credit card rates. Also, higher rates make the overall market, like the S&P 500, less appealing to invest in, right? A lot of people will see rates at 5% and think, oh, I can just put my money in, a high yield savings account, get 5% no risk, over a year. Why would I put myself at risk, trading the S&P and, setting myself up for potential downside moves? So the higher yields go, the more appealing it is for investors to take money out of the stock market and put the money into high yield savings accounts. Okay, so by pulling money out of the market, that sets up for more selling pressure as these folks need to get out of their stock holdings and liquidate their money. Okay, so the higher yields go, the more bearish it is for the market, in plain English. Okay, so to get an idea of a solid headwind on the market, if TNX crosses that 5 area, chances are the market is going to continue dropping to the downside. Okay, so definitely keep an eye on that. A correlation between TNX usually is the dollar index moving higher as well. So usually the higher the dollar index goes, the higher yields will also move. Okay, so I wanted to spot out this key technical area on DXY. Okay, so we use a Fibonacci. We go from the 2022 highs to the recent lows, and you'll see that the market went right up to that 50% retracement level. Okay, so there's no coincidence that the market failed exactly where it did. Going forward, that's going to be a very, very key area. So essentially, because the dollar index failed at that 50% retracement resistance area that in turn allowed the rates to also come off. Okay, so the rates pulled back, because, or part of the reason was because the dollar index hit resistance and pulled back. Okay, so that also dragged down yields, and in return, that's why we have been seeing some resilience in the S&P 500 futures over the last 2 weeks, despite the hawkish things that I went over in the beginning of this video. Okay, so a lot of people are coming into the market saying, how the heck are we rallying if we have hot CPI, hot PPI, a war just broke out, right? We have ugly Michigan sentiment numbers. We have a very hawkish jobs report, right? I could go on and on and on. The reason for the recent resilience in the S&P 500 over the last 2 weeks is because yields have come off, which is very contradicting because yields should have risen on the hot CPI, hot PPI, hot jobs report, and so on and so forth. But the reason that they're coming off, or the fact that they're coming off despite all these hawkish economic prints, are something to look at going forward. Okay, so hopefully that makes sense in that, the higher TNX goes, the more pressure gets put on the S&P, and as a result, the S&P will further see more downside pressure. Okay, now TLT is the bond ETF. So essentially, the higher TNX goes, the lower bonds will move. Okay, the price of bonds. Okay, so if TNX does move higher to 5%, let's just say yields do see a spike higher towards 5%, right? It hits the market. The market has more pressure on it, so the S&P 500 falls. TLT has a support that if TNX hits 5%, TLT should come down to this area. Okay, so this is an area that I will be watching going forward. Right, this was an area that acted as support back between 2002 and 2007. So this was a 5-year support. Call it in between around 82.60 and 80.60. So that $2 range on TLT is what the market should hit if TNX does hit that 5% area. Okay, now if TLT comes down here, I will be interested in swinging leaps on TLT calls, say 5-6 months out. Okay, so definitely look at this shaded area going forward. Like I said, if TNX rises towards 5%, TLT as a result should come down to this shaded area, and if it does, I would be interested in picking up calls on TLT, call it 5-6 months out for an out of the money leap swing position. Okay, so definitely keep an eye on that going forward. Another technical area to look at is on the Nasdaq futures. Okay, so Nasdaq has this key trend line that it has rejected at 4 different times. Okay, so you have a reaction here, right? Then you have a reaction here, then again here, and then here. Okay, so clearly this this downtrend resistance line has acted as clear, a lid on price. So if and when the Nasdaq futures, test this general area, you want to gauge what price does. Okay, so ideally, the bulls want to see a nice momentum, breakout to the upside, and then if they do break out and then retest that area, you want to see that previous resistance turns into support. Okay, so definitely keep an eye on this trend line going forward. Okay, so now we have the S&P trend line as well as the 50-day moving average, right? We went over that. We went over the Nasdaq trend line as well, okay? And then we went over TNX, TLT, okay? So those four instruments will give you a very good idea of what will likely happen next once price does test those areas, okay? So let's see. I have some stuff written down. So going forward, we also have this resistance area that is, that we've been testing as well. So on the daily chart, we have, a test back in June, right? Acted as support, then it acted as support again a couple times down here, and now we are acting as resistance there, okay? So if price does, happen to turn over and fail to move higher, I wanted to go over some key areas to look at on the downside. Okay, so let's just say TNX does move towards 5%, right? Inflation is bouncing back. We have poor earnings reports, right? That's another thing in the near future. We have some of the big, top weighted names reporting earnings. So if price does happen to roll over, you want to look at this level on the S&P 500. So using the October lows to the October highs, we have this 4333 support level. So essentially, over the last 2 weeks, like I said, the market has been resilient despite some hawkish economic prints that we have been seeing. Okay, so if those continue, if those continue to act as headwinds and the market cannot sustain value, going forward, look at this 4333 level as potential support. The bulls want to see that 50% fib level hold. The inability for bulls to defend that 4333 level, right? If they are unable to hold that general area, it will likely set up for a further move to the downside. Okay, so when it comes to trading, it's very important to have a clear roadmap of key areas to look at on your chart, to give you an idea of, how to strike accordingly. So you don't want a lot of BS on your charts that will cloud your judgment. So the only other thing I ask is, if you guys like this video on a brief overview, please drop a comment and give me some feedback. Put a thumbs up, whatever you got to do. Because if you guys do like this, these types of videos, I'll hop on more often, maybe on a weekly basis, and give you, more material like this. But that's it for the night. Peace.